The piercing line candlestick pattern is a two-candle reversal pattern that is bullish. The first candle should be a black down candle and the second candle should be a white up candle. The second candle must open lower than the previous candle's close, and the second candle must close above the previous candle's midpoint. But it should also close below the previous candle's open. So in this context, the second candle is piercing the body of the first candle, and this signal is stronger when the candle does close near its highs. Here you can see an example of a piercing line in the US dollar Japanese yen currency pair. You can see how the second white candle pierces into the body of the first candle. It closes above the midpoint but below the open. You can see from the number of trades that this is a frequent pattern. We saw 96 piercing line signals in the US dollar Canadian dollar currency pair and 83 in cable between 2000 and 2016. Buying the market on the close of a piercing line pattern and holding for 1 day produced an average loss of 0.07% across our 21 markets, with an average win rate of 47%. And it produced an average gain of 0.1% across our S&P 100 universe of stocks. With a 3-day holding period, the pattern preceded an average loss of 0.07% in our 21 markets and a gain of 0.18% in stocks with a 53% win rate. The pattern does not do well in futures, but it did okay in stocks with a 5-day or 10-day holding period. With a 10-day holding period, it preceded an average gain of 0.28% with a win rate of 53% across 4,900 trades, but this was lower than the benchmark average profit. The piercing line is a frequent pattern, but it does not show a huge edge and is probably worth ignoring.